Welcome back. Let's check in on the markets now. China and Hong Kong shares edged up on Thursday to join a broader rally in Asia, with sentiment buoyed by state media reports of potential easing measures from Beijing in the coming weeks. Investors are also anticipating more easing measures from Beijing after state media reported that China's central bank may cut bank's reserve requirement ratio before the Spring Festival at the end of this month. The Hong Kong's Hang Seng has gained 1.1%, while China's Shanghai index is 0.3% firmer, and Japan's Nikkei firmed 3.3% at 0.3, I beg your pardon, percent at the close of trade. U.S. stocks surged on at close of business trade, with all three major indexes registering their biggest daily percentage gains in more than 2 months, as lower than expected December core inflation data and solid earnings from major U.S. banks fueled a rally. The consumer price index rose at an annual rate of 2.9% in December, up from 2.7% the previous month. The S&P 500 gained 1.8%, while the Nasdaq Composite gained 2.4%. The Dow Jones Industrial Average rose 1.6% to 43,214. All right, then the JSE is trading higher today, with the all-share index trading at 0.2% at 83,602. And when we look at the currencies, the rand is slightly weaker at 18 rand 85 to the dollar. It's at 19 rand 39 to the euro, and at 23 rands to the pound. When we look at our commodities, the gold is currently trading at $2,697 an ounce, while platinum is at $941 an ounce, and the price of Brent crude has slipped to $80.93 per barrel. Our market watcher today is Ricardo Smith. He's the Chief Investment Officer at Absa Investments. Ricardo, welcome to On Point. Thank you so much for joining us and to dissect the markets for us. When we look at some of the things that were released on SENS this morning, we see that Richmond's, who's the owner of Cartier, and Van Cleef and Arpels, two sought-after jewelry brands, reported a 10% earnings increase during the 3 months to December. The rich people are still going for their rich things, aren't they?
Yes, afternoon. It is typically a resilient company due to the segment of the market that it caters to being a bit more resilient to economic cycles. It has been a bit under pressure, though, due to China, particularly the second half of last year leading up to year end. And so we have seen sideways movements in that share price. But certainly a lot of positivity in today's sales update, with the share currently up 16% and, recording the largest quarter sales number in their history.
Right. Yesterday, we were anticipating the U.S. CPI figures, and they came out at 2.9%, while there was expectation from surveyed economists for 2.7%. What does this number mean for interest rates in the U.S., and how could that impact or affect South African interest rates when they are announced by the MPC later in the month?
Yeah, I think, depending on the survey you're looking at, it was more or less in line, looking at Bloomberg, 2.9%, slightly higher than the prior month of 2.7%. So inflation remaining a bit sticky around the 3% mark, largely driven by shelter prices in the US. Positively, though, core inflation did come in lower than anticipated at 3.2%, where consensus expectation was around 3.3%. This, will be significant, firstly, for the US Fed looking at their rate decisions. They've been a bit more hawkish of late, and, revising downward what the total cuts for this year could be, from about 100 to closer to 50 basis points. And then that is important from a real rate differential with our MPC locally, as they try to contain currency-induced inflation. And so we could still see more rate cuts locally particularly given the fact that we have cut less aggressively than the US has. And if we still do see more rate cuts in the US, we could, continue to see that here, especially with our inflation being below a target at 2.9% being the last print.
Yeah. At ABSA, you are compiling an outlook for the year, as is what you would be doing at the beginning of the year to try and see where the wind blows to. What has been on your team's notes?
I think this year, we will be looking more to economic impact of a lot of the policies. Last year was a big election year. So one big one is the trade tariffs from the US. And, if you look at their proposed tariffs, around 60% targeting China, 20% to the rest of the world, might increase their revenue, but certainly retaliation from these economies would lead to higher levels of unemployment. Locally, it's a myriad of issues from fiscal consolidation to continuing containing load shedding, which has been quite positive, and we do expect strong economic growth this year than we have seen in the past, given some of the tailwinds that we are seeing in these policy reforms and infrastructure. Big challenge remains transport logistics, and one that's rearing its head is around water infrastructure that would need a bit of attention going forward. Then just from a market perspective, our markets are slightly better value than global markets. And on the global side, it's the opposite, where we're seeing stretched valuations, but seeing strong positive earnings growth still supporting those valuations, and then locally seeing these reforms that could lead to a rally in our markets as well.
Ricardo, thank you so much for breaking it down for us. Ricardo Smith is the Chief Investment Officer at ABSA Investments. He was our market commentator for today.